There is a moment, and if you're in your 50s or 60s, you have probably had it, where you sit down with your super statement, maybe at the kitchen table on a Saturday morning, tea going cold beside you, and you think, is this going to be enough? And then a second thought, quieter but heavier. Is there anything I can actually do about it now? The answer, almost always, is yes, more than you think. And that is what this video is about. I know a bloke, mid-50s, ran his own plumbing business for nearly 30 years, knew how to quote a job to the cent, could look at a bathroom renovation and tell you within 5 minutes what it would cost. But when it came to his superannuation, he had 3 different accounts with 3 different super fund providers, had no idea what fees he was paying, and had never once checked whether he was on track for retirement. Not because he was careless, because nobody ever sat him down and explained what on track actually means. He told me once, standing in his kitchen, super statement in one hand, reading glasses in the other, that looking at his super balance felt like reading a report card in a subject he never studied. The numbers were there, he just did not know whether they were good or bad. And that quiet uncertainty had been sitting with him for years. Here is the thing. He is not unusual. He is the norm. Most Australians approaching retirement have spent decades contributing to super and have never had anyone explain clearly and honestly what they should be doing in those final working years to make the most of what they have built. His wife found him one evening in the study, the room that used to be their daughter's bedroom, now a small office with a filing cabinet and a desk lamp, with statements from 3 funds spread across the desk, trying to add the balances on a calculator. She asked what he was doing. He said, "Trying to figure out if we are going to be all right." That question, are we going to be all right, is the question behind every retirement planning conversation that never happens. And the answer starts with the understanding what you can actually do right now, while you are still earning, while the system still gives you room to move. Right, so here is where it gets practical. The years between 50 and retirement are not a countdown where nothing can change. Under current Australian rules, they are actually the years where the system gives you the most tools to work with. Let me walk you through the ones that matter most. First, consolidate your super. If you have worked for several employers over the years, chances are you have multiple super fund accounts. Each one charges fees. Each one might have insurance premiums quietly coming out. And those fees, year after year, eat into your retirement savings. Consolidating into one fund is one of the simplest things you can do, and it can save you thousands before you retire. You can find all your super accounts through your MyGov account linked to the ATO. It takes about 10 minutes. Now, before you consolidate, check whether any account has insurance cover you would lose. That is worth understanding first. But for most people, bringing it all together into one place is a genuine improvement. Second, maximise your concessional contributions through salary sacrifice. Under current rules, the concessional contribution cap is $30,000 per year. That includes your employer's super guarantee, currently 12% of your salary, and anything you salary sacrifice on top. Money that enters super through salary sacrifice is taxed at 15%. If your marginal tax rate is 32.5% or higher, which it is for most Australians earning above $45,000, that is a significant tax strategy, a real saving on every dollar you redirect into super. And here's the bit that surprises most people. If you have not used your full cap in previous years, you may be able to carry forward unused amounts from the past 5 financial years and contribute them now. That means some people can put well over $30,000 into super in a single year, all taxed at just 15%. It is worth checking with the ATO or your fund to see what unused cap space you have. I know salary sacrificing means less take-home pay, and that is a real consideration. It only works if you can comfortably cover your living expenses on the reduced amount. But if you have room in your budget, even $200 a fortnight redirected into super adds up meaningfully over the years remaining before you retire. Third, understand the downsizer contribution. If you are 55 or older, which is the current preservation age threshold for this measure, and you sell a home you have owned for at least 10 years, you can contribute up to $300,000 per person into super from the proceeds. For a couple, that is $600,000 combined. This contribution sits outside the normal caps, which makes it genuinely powerful for people scaling down the family home. It does count toward the transfer balance cap if you later move those funds into a pension income stream. So it is worth understanding how the pieces connect. And this is exactly the kind of decision where talking to a qualified financial advisor makes a real difference. Fourth, check your age pension eligibility early. This is one of those things the system never explains clearly, so let me have a go. A lot of Australians assume they will not qualify because they own their home or have super. But the pension eligibility rules are more generous than many people realise. Under current rules, a single homeowner can have countable assets, everything outside the family home, of up to roughly $301,000 and still receive the full age pension. That is approximately $28,500 a year in retirement income. For couples, the assets test threshold for the full pension is around $451,000. Above those thresholds, the pension tapers. It does not vanish. It reduces by $3 per fortnight for every $1,000 over the limit. So even with assets above the line, you may receive a part pension and the pensioner concession card, which saves real money on prescriptions, energy bills and transport. Now stay with me on this next part because it matters. The income test and deeming rates. Centrelink does not look at what your savings actually earn. They assume a rate of return. Under current deeming rates, the first $60,000 or so for a single person is deemed to earn about 0.25%. And everything above that is deemed at 2.25%. Your pension is assessed on that deemed income, not your real earnings. Understanding how the assets test and income test work together is genuinely worth your time because it shapes how you structure your financial security in retirement. Here is what I would encourage you to do. Not next month, this week. Log into MyGov and check how many super accounts hold money in your name. Just look. You do not need to act yet. Then check your most recent statement for your current balance and what fees you're paying. If you have not looked in a while, that is completely normal. The system was never designed to be easy to understand, and that is not your fault. If you're still working, ask your payroll team about salary sacrifice. Even a modest amount makes a difference over the years before you reach preservation age or retire. Visit servicesaustralia.gov.au and look at the current age pension rates and thresholds. Even if retirement feels distant, understanding what you may be entitled to changes the way you think about how much super you need to retire comfortably. A super drawdown combined with even a part pension can provide a retirement income that covers more than most people expect. And if you have not spoken to an independent financial advisor, someone who charges a fee for advice, not a commission on a product, consider booking a conversation. Not because something is wrong, but because someone who knows the system can look at your specific numbers and show you options you did not know existed. I understand the hesitation. After the Royal Commission, after years of stories about people being sold products they did not need, the caution around financial advice for retirees is entirely reasonable. But independent fee-for-service advisors work for you, not for a product provider. At this stage of life, a couple of hours with someone who understands the rules can be worth more than years of quiet wondering. If this helped make sense of something that has been sitting in the back of your mind, the next video goes deeper into how minimum drawdown rates work once you actually stop working, and why making your super last in retirement is less complicated than the system makes it sound. If you know someone in their 50s or 60s who has been putting this off, send it to them. Sometimes all it takes is someone explaining it in plain language. And tell me in the comments, what is the one thing about super or retirement you wish someone had explained properly years ago? I read everyone, and your questions shape what I cover next.